The other sector in focus is obviously select Indian metal stocks that are trading at their respective 52-week lows as steel prices collapsed over the last few trading days. Curbs on Chinese production is slowly wearing out amidst concerns around the global economy. So is the honeymoon period over for metal companies in India? Companies which made hay while import duty curbs in India and higher demand aided sales in the domestic market and abroad? Let's ask someone who has been tracking the space for years now. Rakesh Arora, managing partner of Go India Advisors, now joins us with his take in the current scenario. Rakesh, thanks very much for taking out the time. I'm going to start off with what's been happening in China, specific to rebar prices, which have come off the peak that we saw in the month of August, almost 21% given off. And not just rebar prices, construction steel as well has been witnessing a lot of pressure, which indirectly is putting pressure for most of the companies here off. What's the sense and what's this likely to culminate into?
Well, see, China is 50% of global demand. So whatever happens in China is highly relevant for the commodity prices. Chinese economy has been slowing down. The last print was 6.5%. And when I read about Chinese economic forecast for next year, a lot of people are talking about number which is closer to 6%. So definitely, there is a slowdown in Chinese demand. And add to that, whatever is happening globally on the trade war, adds to that growing pessimism about demand into 2019. And that is getting reflected into commodity prices now. I wouldn't say that we are already done with the fall. It could be, even worse as things unfold. I think all eyes are on G20 meeting on 1st December. If something positive comes out from there, maybe there might be a little bit of bounce. But otherwise, I think we are in for a more prolonged decline from here on.
Rakesh, the anticipation was that the winter curbs would come in and therefore there would be a lack of product in the market, because of which most steel producers started to flood the market with inventories earlier on. But because China has been a little bit more lax in terms of implementing these curbs, there is a possibility that the glut remains in the market, which again may not be that good for pricing in the near term. How far worse could this get, and the implications for Indian companies thereof?
So in terms of, you rightly pointed out that this time around the production cuts are less severe. And, obviously people were expecting that cuts would happen. But given the state of Chinese economy, I don't think they can really push. And they've changed the barometer by which they measure, the pollution index. So that has given a lot of leeway. But having said that, I think it's more to do with demand. Demand slowdown fears are much more genuine. And meaning supply has been there over the last few years, but it was demand which was really keeping the commodity prices up. And now that is under question. How far worse can it go? Meaning historically we have bottomed out wherever, when 50% of the producers globally are loss making. So what it means to say that when you are 50% into the cost curve, then only things start to bottom out. We are far away from that. Meaning only recently, steel companies were at their decade high profitability. Same was true for zinc, even aluminum to some extent. So we are far away from that bottom if things were to pan out the way it is looking right now.
Do you see the risk for most of the Indian companies getting a little bit more amplified now with the falling in drop in the Chinese steel export prices, as well as the landed cost of HRC products being at a substantial discount to the Indian HRC products, which could mean that the imports could rise thereof and the implications of that?
Yeah, so meaning Indian market is not really removed away from the global market. So what is happening is going to translate into Indian prices also. Also, don't forget that recently most of these companies have bid for some of those distressed assets, and they will also be very keen to push volume through. So there is going to be a little bit of a supply glut even domestically. So that is also going to add on to the pressure in the domestic market. So overall, things are looking that we are in for a sustained decline in commodity prices from here on.
But do you see, obviously, while we're talking about the lack of economic pickup in China, that probably could not be matched to the economic cycle here in India. Do you see a change in infrastructure spending picking up here, and because of which that could be a slight silver lining for steel companies here in India?
No, India is no match for China. China is 50% of global demand. China is 5%, and India is 5%. So I mean, there's no comparison altogether. Whatever happens in India is not going to influence globally, I would say, at all. Now coming to India per se, I mean, there will be a little bit of pickup in demand till March. But remember that we are also heading into election season and things start to slow down. So probably another 3-4 months, and then things start to slow down for 6-7 months, and we get a supply glut from all these revamped, restructured assets which have been bought over. So I won't be really too bullish, despite Indian infrastructure doing better than historically.
Right. So Rakesh, in an environment like this, where obviously long-term value creation is something that the companies will be taking on in the process, for minority shareholders at this point, what should be the focus? I mean, should be the focus remain on companies trying to shed off their debt, most of them trading at the net debt of about 2 to 4 times? Is that something that you should focus on when you're looking at making investment into some of these metal companies right now?
See, metal companies normally don't make for a long-term investment. You have to play the cycle. So currently the cycle is turning downwards, and these companies have taken debt at the wrong period of the cycle. Meaning when things are starting to turn down, most of these companies have saddled themselves with debt. So they don't really make a pretty picture in terms of investment. One needs to really wait for the cycle to play out before getting into most of these names. But having said that, some of the companies have been more, better placed, like Coal India, Hindustan Zinc, where they don't have much debt, they are sitting on cash. So they could be at the best hiding places, but when things fall, everything will fall.
What are we to look for going forward, probably into the next 1 year? I mean, while you say you play the metals cycle as a whole, do you see this period of lull changing anytime soon, and thereabouts, which are the more better placed companies to take advantage of the next upturn cycle?
Well, so see, what can change the thesis is, as I said, one is G20 meeting where China is meeting US president, and if they don't really go ahead with the increase in tariff and the trade war comes to a standstill, that is going to give some support to commodity prices. Number 2 is that inflation has come down. If we can get some signals from US Fed that the rate hikes which are being penciled in are going to be lower than that. So these are the 2 variables which can really change the thesis from what I'm saying right now. But the probability of both looks low, so at the moment we need to wait and watch.
All right. Just one last question before we let you go. In terms of you've already spoken about how these companies have been trading at their relative highs. Valuations have been a bit stretched as well for some of these metal names. But in terms of just taking a pure play call on valuations, how would your pecking order look like?
Well, see, I don't really track them so closely, but as I already told you, that companies who are debt-free would be higher up the order, and worse the balance sheet situation would be the lower end. So avoid companies with very high debt, and in this environment, you can't take that kind of risk.